Hi, we're here at the 2022 University of Virginia Investing Conference. You know, Jan, when you were on stage, one thing I think we all got a deep appreciation for is your respect for history and how much your historical perspective informs convictions about, you know, certain asset classes or investment ideas and so forth. And you'd shared one with us that might not be on everybody's radar screen. I wonder if you might reflect on that for our audience watching here.
Yeah, sure. I mean, my favorite asset class is fixed income right now. And I say that, and I got more conviction is by looking at the 1970s and the data. Now, that was a great decade for commodities and gold, which is, you know, something we do as a firm. But when you strip those out, what really shocked me is that bonds outperformed stocks during that era. And I'm not saying we're going to the 1970s per se, but some of the dynamics, I think people have forgotten the beauty of getting 8% on a fixed income return because we don't even remember what that was like. And the benefit is that you reinvest all those dividends, and so it's really compounding at a high rate, which makes up for some of the problems with you can have with fixed income. And then also, an interest rate move from 0 to 3% is way worse than 8 to 11% from a duration perspective. And so I think you've had a lot of downside. I think it's not a bad place to look.
Oh, we appreciate that, and lots for us to reflect on for sure. And you know, a theme for the day has really been, or maybe a common thread throughout the sessions, has been the Fed's activity and what they might or might not do moving forward. Will they stay their current course, or will they, change their minds and move in a different direction? I wonder if you might share reflections that you have about that with us.
Sure. I think that the Fed did one of the biggest stimuluses ever. And now what I describe as the fight is with wage inflation, because we're a services economy. So the most important cost input is wages, number one. And number two, it can be a very pernicious dynamic because once you have to pay more because someone else got a wage increase, then you want a wage increase, and then your wage increases someone else's desire to have a wage increase, and everyone's got cost of living increases, and how does the Fed stop that? And so I think they could be tighter for longer, and which is why I think you might get paid in fixed income. But listen, who knows? It's just a scenario I think that's underappreciated.
Well, you've given us so much to think about, and we've learned so much. So thank you so much for coming to the University of Virginia Investing Conference. Thanks again.
It's been great, yeah.